Okay, thanks for coming in this afternoon. I'm Michael Cole. I'm from Right Side Consulting, but you may know me better for my real estate information website, MIPIM. And I want to thank you all for coming in for our session this afternoon on Asian investors going global.
Excuse me.
Specifically, we're looking at Europe versus the USA. So where are investors more likely to go to, particularly as we head into 2015 and this trend of Asian capital going outbound continues to increase. So I do have a panel of experts here from a number of different backgrounds to help us out today. Before we get launched into that, I do want to give a little bit of background on what exactly the issues are that we're dealing with. And let's see if I've got, I think we've got a couple of slides there, if we're ready and back. Okay, all right. So basically the topic of our discussion is Asian investors. Really they're going in search of real estate returns. This is something that's been building for a few years now. And they've been heading overseas. There's been a rapid increase in the capital flows from Asia, where capital used to be coming into Asia from the more developed world. Now people in Asia are being cashed up and they're looking for returns somewhere else. In 2014 alone, it's now estimated that the Asian capital going into the U.S., sorry, Chinese capital going into the U.S., into the real estate market will be more than 15 billion. And that's already more than double the amount for 2012. A lot of that is really generated by the mainland market slowing down. Now, not all the capital is coming out of the mainland. A lot of this is coming from other areas in Asia, but a lot of the developers, the investors, previously were looking for opportunities in China. Now that the China market has slowed down some, we've seen, I think it's 7 months of declining housing prices in China this year. People are looking at other opportunities to get that return that they used to get in China. So you have people really looking from China, from Singapore, from Hong Kong, looking at US and European markets as well as other areas. So you've seen Asian investors going into the US. I think it was the end of September, the Unbound Insurance bought the Waldorf Astoria for nearly $2 billion. Fosun last year acquired One Chase Manhattan for $725 million. So that looks like a small transaction now. You've seen developers going after development sites in the U.S. with Greenland Group buying the sites in L.A. and in Brooklyn. But you've also had people going into Europe as well. So China Life this year bought 70% of a tower on the Canary Wharf in London in a $1.35 billion deal. Also, China's Jinjiang Group just last month bought the Louvre hotels from France for $1.49 billion. Dali and Wanda on the development side has been buying projects in Spain. They bought projects in London. So both the U.S. and Europe are seen as by Chinese investors, by investors from elsewhere in Asia, as having a lot of upside right now. So how much upside is that? It's difficult to say, but the perception is that values are low compared to pre-global financial crisis. So we're trying to look at what the outlook is for 2015, what's the appeal of each market, which market is likely to draw the most investment in 2015, how ready are Asian investors to really execute deals? So are people really prepared to go through some of the regulatory hurdles to actually do the due diligence necessary to invest in these markets? These are some of the questions that our panel is going to try to work with today. I'll give a very quick introduction to our panelists, and then I'm going to let them introduce themselves. We have with us today, we have Scott Picken, who is from MIgrate from South Africa. We have a whole selection of Charls for you here today. I hope that's not as confusing for you as it is for me. But we have Charles Janke from Austin, Texas, who is involved in transactions, brokering, and as a lawyer. We have Philip Charls from EPRA, which is the European Publicly Listed Real Estate Association, is that correct? Who's very much representing the listed European developers. And we have Charles Cosgrove, who's based in Singapore, and who's been working in real estate in Asia for about 20 years, primarily in the private equity space. So maybe, Scott, you could tell us a little bit more about yourself beyond what I've been able to explain briefly there.
Perfect. My name is Scott Picken. I'm the author of the book Property Going Global. Since 1998, I've been completely passionate about real estate crowdfunding. And what we've actually created, I'm the founder of MIgrate, which is ultimately the global real estate marketplace. In simple terms, it's the Alibaba, but for real estate. And what we've created is a bridge of safety to help people in Asia to be able to invest in the West, but in simple terms, the emerging markets to invest in some of the best first world markets like Australia, the UK, and America. What differentiates us is that we've helped 1.34 billion, our clients have trusted us with 1.34 billion over the last 30 years on 4 different continents, and our primary focus is safety, wealth preservation, and helping people grow their global wealth.
Charles?
Thank you, Michael. It's my great pleasure. I hope that I can give you some good information about the U.S. market. I have been doing business in China for 25 years. My company has the exclusive distribution and rights for the very famous National Association of Realtors in China for their global programs. Consequently, I work frequently with all of the major real estate companies in China, including all of the commercial developer and the commercial developer groups. Because of that, and because of what's happening now in the marketplace, my company, China United Real Estate Group, works almost on a daily basis with Chinese investors that are investing in commercial properties in the U.S. My background is one of international law, international brokerage. We do international tax planning and immigration. We do the full process, the vertically integrated transaction for Chinese investors in the U.S. So I hope that I can share some information about that with you today, all of these aspects. If you have any questions, please let me know. Thank you.
Thanks, Charles. And Philip? Can I call you Charles, or just Philip is okay? Philip?
I mean, most countries mix either way, Philip, Charles, Philip, Charles. It's very multifunctional in that respect. No. So my name is Philip Charls. I'm a lawyer by background. Started my career as a European competition lawyer in the 70s, that is 1970, and then worked for about 25 years for ING and joined EPRA in 2007. EPRA is the European listed real estate company. They're not developers like Microsoft, but they're really the asset holders. A very small percentage in development, which is mainly by law, by REIT legislation. We're very closely to EPRA, Peter Burwick in the room, and Navy in the United States. We have 3 main activities. But we first give you our members are about 220 members, 50% the property owners, and then we have the international investors, can be either Fidelity or the big pension funds like APG, PPGM, as well as the banks, the consultants, and a lot of the leading universities, because we do quite a bit of research. So we have basically 3 main activities. Number 1, standard setting with regard to reporting and accounting, to make Europe, which is still a lot of different countries, to make it more cross-border comparable. We do it in reporting and accounting, as well as sustainability accounting, which becomes increasingly important. And then investor outreach. That's why we are here in China. In Asia, we opened an office a year and a half ago in Hong Kong, reaching out to China, Hong Kong, Singapore, Taiwan, Korea, and Japan. I have one small footnote to make, being a lawyer, with regards to your mentioning of the Chinese acquisitions abroad. When they got the permit from the Chinese Insurance Commission to go outside, the first thing they did, and it was really tongue-in-cheek sort of sense of humor, is buying Lloyd's of London building, which, as you know, is where insurance business started. So, I mean, historically, I think it was a very, very interesting move.
Very good, Phil. Thanks very much. Charles Cosgrove, what can you tell us about yourself?
A lot more than we have time for, but Arch Capital, as some of you may have observed, is a sponsor of this conference. It's something we like to do year in, year out. We're a typical private equity model boutique Asian property fund manager. It became a business. It was a business that I started when I was at the Ayala Group, where I managed the offshore balance sheet investing, most of which was in property. for over 15 years. Together with a fellow named Richard Yu out of AIG, we started this firm back in 2006. We're on our third fund now, cumulative capital raised approaching $1 billion. It was an interesting time to get into the private equity real estate business in Asia, 2006, 2007, but so far so good. My background is a real estate lawyer. I trained at Sherman & Sterling in New York, where interestingly most of our real estate department found themselves in the private equity space later in their careers. And I'm on this panel probably with the interesting perspective of somebody who is habitually raising capital for Asian markets and Asian destinations. Even as on this panel we talk about what is very clearly a secular kind of move of capital back into the more developed markets, which I suppose is going to be an interesting discussion to have, particularly for those of us who spent many, many years at conferences like this, almost avoiding the idea that capital could actually go in the other direction.
That's actually a good. That's a good point you make there, Charles. So what's causing that? So you're saying that now there is actually some capital going back in the other direction. Why do you think that is?
I don't think I'm smart enough to know why. I think the question is it a significant and a sustainable trend? I think all the anecdotal evidence, and we're not involved in that as an organization or as a manager, but I know that some of our investors would like us to be. And the reasons for it, and I'm sure the other panelists have got their own views on it, and some of them are very, very focused on the allocation decisions and how they structure those investments in certain markets like North America. There is, in each country, something slightly different going on. We can talk about China, we can talk about Indonesia, we can talk about Singapore, we can talk about Hong Kong. I've been in Singapore over 20 years, and one of the first things I noticed coming from San Francisco was that upper middle class families were buying apartments in London, even back in the 90s. And the reasons for that in those days were pretty straightforward. Mother and father had gone to school in the UK. They anticipated that their kids would be doing the same. It was not a small thing, it was actually quite widespread. That then spread to family offices, corporations. Pretty soon you had more entrepreneurial activity going on. Capital was being raised among friends and family in Singapore, Hong Kong, even in Kuala Lumpur. And they were taking over whole blocks of apartments in London. So this movement, at least as far as I'm concerned, really started in kind of in a retail way back in the early 90s, and I was very surprised that people were prepared to go that far for returns. So
you think this really started with the sort of wealthy individuals and has gone sort of up the chain towards the corporate investors, towards the private equity investors, towards the sovereign wealth funds, sort of up the pyramid from the bottom? Do you think that's the trend? Well, again, I'm not smart enough to know, to be too systematic about it, but in my analysis. But this is what I observed. It was literally hundreds of millions of dollars that I probably, among a group of 40 or 50 people that I saw actually being shifted to first London. Then after that into some retail and rental properties in the UK. Student housing, for example, was being done by individuals. As far as I can tell, they were buying 40, 50 homes at a time in university towns back in the early 90s. Philip, about this point of things being sustainable, I've heard in terms of reading the newspaper and such, I see a lot of people comparing what's happening with the Asian investors right now to the Japanese buying into the U.S. And other markets during the 80s. From where you stand, are the Asian investors making good investments? Is this a sustainable wave, or is this something where a lot of people are going to get burned and run back home to their home markets?
I think the game ours is obviously a long-term game. If you look at the history of real estate, and the number one question I always have to answer with a lot of people now, actually, Charles, what are you? Are you a stock or are you real estate? That's one of the first questions. You don't even know what you are. Well, basically we do know, and there's a lot of research we've done that yes, short term there is a correlation with the stock market between 5 years, but after that, and it's a long-term game, we behave exactly like underlying. Now why is then this interesting? Number one, first of all, is diversification. I think that's exactly what affects foreign investors. I'm not talking only about Asian, but it's a global game. There's a lot of American money coming in as well. It's a diversification. You can buy the region, you can buy countries, you can buy type of assets. You just mentioned student housing. There's some big UK companies at the moment who are specialized in that, like Unite. You can buy shopping malls. If you buy one of the French companies, you don't buy the whole country, you buy it pan-European. So, if you buy Unibuy, EPRA, you have a whole European-wide set of the best shopping mall portfolio. You can buy into the best offices in London, the newest one like British Land and Land. So that is how I see the development a bit parallel to buying direct assets. I mean, you just mentioned earlier what Chinese have done. The Koreans are very active, and I have this discussion with them. If one of the biggest pension funds in Korea buys for 750 million the HSBC office in Hong Kong, and at the same time for 250 million the Sony Center in Berlin, both fantastic assets. I think they can do a better job by spreading the risk. If you want to do retail, buy Unibuy, buy Click here, to buy all the best shopping centers you can get in Europe, but you're not in one city. I'm not saying Berlin is a bad city, it's a great city. The same for London. If you want to have newest offices, buy British Land, buy Land Security, you have all, the latest stuff, plus highly sustainable building. So, I don't know, this is the answer to your question, but I mean, this is in general how we see the market development. And yes, I think, I'm sure like in any other business, there might be people who get overly enthusiastic because they want to see themselves in front of a huge office tower and pay too much for it. That's life, right?
Well, there is that sort of trophy element to a number of these acquisitions. That's for sure. Charles Janke, now for you, how much you're dealing a lot with the Chinese developers? You said. Now, how much of a role do you think that the change in China's property market in the last few years has had on this drive to go and acquire assets overseas, or to invest in publicly listed real estate vehicles overseas, or just to get capital into something overseas?
It's certainly a large dynamic. It's a large factor. But I can say that just a little bit of the chronology. I have a lot of data from the National Association of Realtors because I represent them in China. 2 years ago, when I spoke at the National Association of Realtors annual convention before thousands of real estate agents in the United States, the topic of my speech was how to market and sell to residential property to Chinese buyers and catch the buyers and complete the transaction. 8 months ago, everything changed. Because of the dynamics in China and because of some other factors, everything shifted to commercial purchases in the United States. And what we've noticed is that the large SOEs, of course, are interested in the trophy properties and the landmark properties that you're talking about, and we work with them. But what's happened that's really fascinating, really exciting, and I work in this every day, is that within the last 6 months, we find the smaller and medium-sized Chinese wealthy individuals and funds looking to purchase that $10 million to $50 million commercial office building in the United States. And what's happening is that this is also very, very interesting. A year ago, the tremendous interest was in the California market and the New York market, and everybody wanted something in California or in New York. And our statistics show that even today, 35 to 40% of the Chinese buyers are looking for something in California. About 20% are looking in New York. But what happened was an economic principle took hold, and that is that the tremendous demand for these properties increased the price in all of these cities, and consequently, the cap rate was greatly reduced. So now it's a dilemma for the Chinese buyers because on one hand, they're enamored attracted emotionally to California and New York. But we notice in the last 3 or 4 months, and I work in this area, that people are now very interested in Texas, which has some of the best cap rates in the country. And Dallas and Houston have become quite, and Austin have become quite popular. So in a roundabout way, it's what's happened in the Chinese market now is a driver, but it's actually part of a whole process that's taken place, and a shift from the loosening of things in China to the availability of non-recourse, great interest loans for Chinese investors in the United States that are really driving the present interest in commercial properties.
Interesting. Well, Scott, for you, I guess with your platform, you're really covering real estate in all parts of the world. In terms of what you see, are you able to track activity there and see where people are making inquiries, what people are investing in? If so, what seems to be driving the most interest right now? Is it Europe? Is it UK, North America? To
be fair, pretty much what Charles mentioned. There's still a huge amount of demand for the UK, specifically London, and then the US and Australia. Those 3 primary markets is where the vast majority of demand is. Mm-hmm. What we do find is that there's still a huge amount of investors that are investing in residential products, but the commercial, pretty much what Charles is saying, from our perspective as well, has really, really grown. And one of the things that we're finding really, really interesting at the moment is that, and they actually spoke about it, Dr. Amlin Roy spoke about it this morning, one of the macro trends that was spoken about at MIPIM in March in France was medical. And what we're finding, you spoke about trophy products and people chasing them. It's certainly happening, but we also believe that people are getting wiser and wiser. So in the past, most people used to invest in their local region because it was easier. They didn't understand the tax, they didn't have the right information, they didn't have the right partners. But now with the access to the internet, access to travel, it's becoming far more accessible to get access to good opportunities. And yes, there are the trophy markets of California and New York, but people are starting to take cognizance of macro trends, follow those trends, and find good opportunities in those first world markets.
Okay, that's that. I mean, there is that role of the internet in terms of giving people access to places that they didn't have before. They can go online and learn a little bit about it and then follow up. It does change things quite a bit over what it was 20 years ago or something.
If I may add something
absolutely.
To Michael, if I may. It's interesting. It's exactly what we see in Europe. What we're doing is, of course, with a liquid product like listed real estate, is that you have NAV, which is net asset value. So you see at the moment that people now tend to move to markets where there's still a big discount, and that is not in London, obviously, where the leaders have followed the premium. But you look to certain parts of Italy. That's only beginning. We worked very hard to improve REIT regimes in countries that were hardest hit by the crisis, like Ireland and Spain. They introduced new REIT regimes, and immediately billions came in, particularly from the US. Just the last 12 months in both countries. And so there you still, they are at par, but there's still opportunities in pockets where you can discount to 40–45%. And that's, I think, where you indeed see the money flowing now. So it's very interesting how it moves from the regionally big centers into more regional areas.
And for any of you, if you have something to add on any of these questions, and feel free to jump in and say, hey, I've got some ideas on that as well.
But I also think, just to answer that, I think from what Charles originally said, when you look at it, it's a common sense phenomenon that history's had for a long time. The Roman Empire did it. The British did it in the 1800s. The Chinese are doing it in business right now and accumulating businesses and assets. And the more that you invest outside, the stronger you actually make your own country. So it's a very positive thing.
No, I would agree. In terms of...
Not everybody in London does, by the way.
There's
a lot of headlines in the Times and all that. They have all these these apartments and the lights are never on. And that is really, people are not happy that they put it that way.
So is that China exporting their ghost cities?
It's not only China. It's a lot of Russian, Greeks. Greek is not bankrupt. I mean, they all live there. They hold the money there, and they want to buy the bankrupt country whenever it's really at its lowest. And at the same time, they've seen the prices going up in London 3 times. So, but people are upset about that. And the Wanda guys know that because they're part in the project is in social housing in that same industry project that they have. So.
All right, in Charles Cosgrove, for you, I've noticed, well, we mentioned earlier about some of the large-profile, high-profile sort of trophy acquisitions that we're seeing, that whether it's the Lloyd's of London building or it's the Waldorf Astoria. Is this, from your experience working in Asia for a long time, is this, what's driving this kind of acquisition? Is it some sort of ego need, or are they going to get a real return on this? What's going on with that?
Well, I'm not a psychologist, so I really don't know. What I know is one of those transactions had a 100-year management agreement on it. So there must be an aspect of that transaction that perhaps the public's not privy to. But maybe there's another way of looking at it. I wouldn't want to call them trophy investment strategies, but over time, and when I was investing balance sheet capital rather than time-limited money, like as I am today, we had a longer perspective. There was a view that global gateway cities were investable, and that there was always going to be demand for those assets, even if they were chunky. And therefore, there was liquidity, and there was usually debt in the markets to support, the next buyer. So how do you define global gateway cities? Well, there was, for a time, I think it was a rather small handful. It was New York, it was, London. Interestingly, I don't think Paris has ever enjoyed that, except perhaps in the Middle East, where they've always enjoyed the residential market in Paris as a place to go, particularly in the summers. For a while, I think Tokyo was seen that way. So as I said, you could count them on one hand. Now, I think global gateway is defined somewhat differently. There are more. I think the criteria for determining what is a global gateway city probably evolved. I don't know if Shanghai is there yet, but I have this sense, and I'm a Californian, that now San Francisco, for example, has become seen as a global gateway city. I have a daughter who goes to school in Boston, and I noticed the condominium prices are rising in Boston. And when you look at the residential prices in Boston, and Boston Globe just covered it yesterday or the day before, they're now moving out of reach of local young graduates from universities in Boston who work and want to stay in Boston. So what's happened in London is kind of happening in some of these other cities. San Francisco's got an affordability issue. Boston's got an affordability issue, just like London has for many years. So I wouldn't say that's a substitute for trophy assets. I still can't explain why somebody would do those deals, and it's as I said, I'm probably not smart enough to see the real picture. But investable cities in the world, that I think is kind of the new picture, and I think that's kind of what the migration of capital towards those markets is really all about. I don't know how analytical we should be about it. It is what it is. It's a hydraulic concept, right? I mean, money, capital, and water, they all find their own levels. And there's a variety of reasons for why people do things. I feel it started at the retail level. It's become institutionalized. In Singapore, GIC was way ahead of the pack in terms of sovereign wealth funds who were investing in really high-quality assets in different markets. So they did that because they don't have a domestic mandate, so by definition they had to go outside. So again, I think we shouldn't dwell on the trophies, in my opinion. We shouldn't dwell on high-profile deals. We should look at kind of the on-the-ground data and the phenomena and try and figure out, perhaps as business people, how we can get ahead of it.
Interesting. Well, let me tell you, let me ask.
One about the wall, because I think that's really interesting, not so much about the price, because I think it was $2.5 million for key or something.
What's that?
For the wall, the price was $2.5 million for key.
Man, I don't know. I tuned out of that when I saw the
people
price.
say, okay, how can this ever work? But I think the other very interesting thing that maybe not everybody knows, but I think it's the hotel that's always used by the President of the US, and he has his own secret exit passage there. So there might be,
Let me offer an anecdote. I don't know about the President of the United States, but when it was really cold, I worked in Manhattan for 5 years. My office was Midtown. And I lived on the east side, and what I used to do is walk through the old Waldorf Astoria on very cold, windy, wintry days. So it had value to me as a corridor, if you will.
It's a shortcut to
the east side, yeah.
Well, I'm not sure if the people from Unbound Insurance really were there in the winter, but I think they just bought that over the summer. But anyway, they probably looked at that for about a year. Maybe it took. It's a Chinese insurance company. It's a SOE. It takes them very long to do any kind of transaction. So if you're a Chinese SOE, you're very cashed up. You've got to get some return on your capital. Now, are you going to do 10 transactions a year? Probably not. Maybe it's in your interest to do one really big transaction a year. So maybe how many cities in the world can you do that in?
Well, look, I mean, one possibility is they could condominium as part of the, or all of it, if the management agreement permits it. We have no idea.
Yeah.
So you could, in effect, you could unitize ownership. I mean, I'm literally making this up as I speak, okay? But if I were in that position and I had a single core hard asset, I would say you could probably find a way, not unlike, what I think might have been attempted at the Plaza Hotel, is to, carve up the ownership. And you have a lot of appetite, I think, for that kind of an asset out there, as long as the management agreement can work with that ownership kind of restructuring. So it's hard for me to believe there isn't a plan out there. I'm not privy to what it is.
So there's, they don't come and call me on the phone either. So I wish they did. I wish they did. About this, between the global gateways and some of the second-tier markets, that's one of the big questions is, okay, with the global gateway cities in the U.S., whether it's New York, San Francisco, London, with these cap rates getting compressed, there's less opportunity to get some upside out of that. What a lot of people are speculating on is that there's opportunities to make that money in some of the second-tier markets. I'm getting inquiries from people saying, we've got some land, we've got some projects to sell in Atlanta, in Houston, in Manchester. So is that really going to happen? Are Chinese investors, Singaporean investors ready to go into some of these second-tier markets, or is that too accessible? Charles, thank you for the U.S. How ready are people to do that?
It's happening. It's happening. Okay. It's a function of the mentality of and the appetite of the particular investor. For example, you'll find that as I said before, the SOEs, some of the larger enterprises, really just would prefer to put their capital in a trophy property in a gateway city. But my clients, the people that I work with that are doing the $10 and $50 million transactions in the United States now are very, very skilled at, and many of them are U.S. educated. The Chinese that I work with, many have had degrees from Columbia, MBAs from Stanford, and they're very sophisticated. They are running all kinds of complicated IRRs, many different formulas that are being used to determine the IRRs, and they're looking now, they're opening their eyes to Houston, to Austin, which is just rated the #1 city to invest in by Jones Lang LaSalle and also by the Urban Land Institute. There are other cities in the U.S. that are attractive, I'm just thinking about the U.S. now, that are attractive to Chinese. What they primarily look for is, first, is there an Asian community there? Is there a Chinese population where they can feel at home? Is there a university where their kids can go to school and get a good education? And some of them are also looking for where there is a particular EB5 investment program that is attractive to them, that's secure. It's a slow process. It's a slow process as the Chinese investors begin to look at the IRR and look at other cities. It's happening. One of the things that is also a somewhat of a not an impediment, but it's something that restricts this expansion a little bit, is that the typical Chinese investor that is not the SOE, the medium-sized investor, is really very good at running the IRR and looking at cap rates and understanding that. But the moment one actually gets in, starts doing the transaction, starts working with the complications of the legal issues, the international tax issues that are involved in the U.S., some of the immigration issues, this slows down the transaction, and one must spend a lot of time educating. So it's a process that is happening, and it's happening slowly.
Okay, so
can I add to that?
Absolutely.
From experience in literally the last 3 months, we've actually had a lot of investment in 2 major sectors. So one was medical, and you mentioned the city actually, which was Atlanta, and the other one was Houston.
Yeah.
And to give you an example, in those type of markets, you're getting cap rates north of 8%, you're getting IRRs north of 20%. And what we're finding is that specifically the really big funds and REITs are where the capital is $10 million plus, and the moms and pops are the $1 million and below. And there's a really sweet spot for capital in the $1 million to $10 million. And that's where there's a number of opportunities in those markets. So I mean, that would be as an example of what we just happened right now in the US. We have $16 million raised on 5 different continents. So definitely there's demand. And equally, it's been in cities like Brisbane in Australia, where it's been in residential development opportunities, in office parks, and also in aged care. And all 3 of those, you'll notice that it's not just a spray of projects, it's actually more about verticals and the city.
Yeah, if I may just add to that a little bit. I have a client now in China where we spent a lot of time. It's a very large commercial enterprise in China, a very famous enterprise. And there was a split in their management. And one of the issues, one of the big decisions they had to make, and we looked at it both ways for them. One group in management wanted to buy a trophy property in Manhattan. It had to be a trophy property on 59th Street, and we knew the one that it was, and that was it, and it didn't matter that it was $650, $750 million. It didn't matter what the cap rate was or the IRR. Another group of management was leaning toward saying, let's buy 10 buildings for about $50 million, where we can get cap rates, this is New York, of about 4%, cap rates of 4, which is quite good for New York, and we should do that. So there is this opportunity for, we find the sweet spot in the range of, and we work in the area from $10 to $50 million on these properties.
Interesting. Now, let me give you guys a little scenario. I'm sorry this wasn't any of the questions I sent out earlier, but let's say I'm on the mainland and I'm from Wenzhou. Now, Wenzhou is a city in Zhejiang province. It's very famous for having very wealthy traders, where people traditionally in the last 20 years have done a lot of real estate investment. Now, the Wenzhou they come into Shanghai, they buy out whole buildings, floors of buildings as groups. It's sort of their own private equity. They go into a developer and say, look, we'll buy 4 floors of your building off the plan, and what sort of deal will you give us? Now, the return, when China real estate was going up double digits every year, this was a great deal for these Wenzhou rent. And these guys they typically own a trading company. They can get capital offshore if they want to. Now, if I'm in that situation and let's say, among my family members, we've got $20, $30 million to go and invest in something. We can get capital offshore. What should we be doing if I'm a Wenzhou millionaire looking to find that same return where I used to get 10% a year, 15% a year, 20% a year on buying apartments in Shanghai, and now I want to find that overseas? What should I be doing? Go for it, Scott.
So I just want to speak from experience to start off with. I bought my first international property at the age of 22. I lived in London for 9 years. And if people think that they're going to leave Hong Kong and fly over to New York and in 1 week find a good opportunity, they're going to get cut up. In fact, the statistics are something like more than 80% of people that invest overseas actually lose money, which is the #1 reason. So the returns you're talking about, it's the complete opposite. The first thing they've got to do is they've got to get the right information. The second thing they've got to do is what I think most people here are saying, is find and talk to the right partners. And if I was to turn that around and say to them, so right now I'm trying to buy a generator. I told you this a little bit earlier. So in the past I would have had to fly over China, try and figure out if the company even existed, whether I was going to get my generator. And now I can just go on Alibaba. They've already been pre-vetted. I know that I'm dealing with a quality person. They've got a quality track record. And I know that when I put my money in, I'm going to get my generator. Really, to answer your question, that's where the world is going now. And they can look around. There's plenty of opportunities. They've got access to different partners. They don't need to necessarily get on an airplane and try and fly everywhere. But what they've got to do, for me, or personally, where we found those returns that you're talking about, is in the 3 markets that we've spoken about in terms of the UK, America, and Australia, but specifically in verticals where there's demand rather than just spray and pray. And from experience, try and stay in the same genre, try and stay with the same partners, and try and make sure it's scalable, because you are going to make mistakes to start off with, and make sure that you can learn from those mistakes and do it again.
Anyone else want to tackle this one for the helping out the Wenzhou billionaires?
We find from our experience that it's to be a little bit technical. We find that rather than just investing in a commercial office building with a good cap rate, or looking for an apartment complex, multifamily near a university in the United States, right now what I am doing actually is we are forming regional centers and EB5 projects for some of these groups that you're talking about, that actually have learned that you can actually form your own regional center and form your own EB5 project. Because you are Chinese, you have a built-in buyer market here. You can take that buyer market and transport it to the US using the EB5 regional center and provide a green card as well as a return on investment to a Chinese family. So this is one way that one thing that we see happening over the last 3 or 4 months in the United States.
So Philip, I guess they're not going to...
I can help you out there.
I'm glad you can, but help my Wenzhou friends.
Yes, you're Wenzhou friends. So I have 2 answers. As a CEO of EPRA, as a private individual. I'm not selling anything privately, not to make that clear right from the start. So no, as a CEO of EPRA, I would look for, like I said before, there's still a lot of value. There are companies that are quoting at a 45% NAV. Now, it might be that there are good reasons, because the country is shaky or all that, but there are some of them to be found that really have a lot of value. So you need to look why it is. Is it because there's just a change of management? Are there some issues that are dealing with? Do they get a new board member? What is going on behind the asset? And I can assure you there is opportunity. As a private individual, I think what we see at the moment is phenomenal in a city like Berlin. It's completely right what you said. I mean, the Chinese and Asian investors just in general look first of all for English-speaking countries, which is not a great favor for Europe, because actually only the UK, who doesn't even want to be in Europe, that can fit that bill. But the other thing is the city like Berlin. It's in a lot of young people are in design and design business and who like this. Like you said earlier, the huge cities are a magnet. Berlin is a super magnet. And the value per square meters is still ridiculously high. And if you look at what design people want, they basically want to have, I think, 3 cities in the world. One is London, one is New York, and the third is Berlin. So, I mean, that's.
It's what you say is really interesting about Berlin, because we attend a lot of the property shows in China, and I was shocked at a show that I went to 4 or 5 months ago. It was a Berlin real estate company. Their business was booming. And I said, wow, this is quite strange, because I've just never seen this before. Why would anyone want to go to Berlin? It's cold. There's nothing happening there. And on top of that, it's very difficult for Chinese to get a visa. They're not like the other countries in the European Union that give the residence permits. And they said it's just a city where people want to go. There's a good opportunity for investment. And they find it just a great place for a solid, secure investment. Whereas many Chinese are driven by the visas that they can get from Spain or Portugal or other places.
I often find that if you have enough money, then visas are not that hard to get.
Yeah, so I just sold first world assets and first world income. You can go anywhere in the world, but generally visas and good assets are mutually exclusive.
Charles, did you want to tackle this one at all, or maybe we'll move on?
There's plenty of wisdom on this panel. I will say that if I'm coming from Windsor, I think capital preservation is probably pretty important because they had some very recent unfortunate history there, right? With a lot of private investors lost a lot of money. So if you're really talking about that community, I would assume their capital preservation and kind of modest risk profiles would make sense, and in which case, obviously they'd be looking at income properties. So.
Interesting. Philip, actually another question about Europe. Okay, we've talked about London, we've talked about Greece. I saw that actually earlier this year, Fosun. We talked about London, we talked about Germany a bit. Fosun did a deal earlier this year to buy a very large development site outside of Greece. So if I'm a Chinese investor and I'm looking for higher returns, are they ready to go into, say, Spain or Italy or Greece where there's perhaps some more upside in the market, or is that not really happening yet?
I think it is happening for, like I said earlier, for Spain and Ireland. Definitely. Greece, I'm not so sure about. I know that they're doing this, and I think it's also for strategic pushes.
Sure.
This whole airport stuff like. I think the big interesting one to follow will be Italy. Italy has a huge debt to GDP. I think it's sitting around 140%. So, and they do have assets. The government, not all of them of great quality, but you can't buy Venice, of course, though you can buy parts of Venice, but the really, really shady parts of Venice, of casernes and stuff like that. So the point is, they have just passed the new rate legislation a couple of weeks ago, and the Renzi government really wants to move stuff forward. So I'm really eager to see if they really get it and understand the concept of transparency and corporate governance, which is two issues that are not commonly commodities in Italy, nor the transparency nor proper corporate government. But I think there will be stuff happening there. So I think that's an interesting one to follow.
All right. Just on a more U.S.-based note. I've seen a lot of information out there about how if you don't structure your deal properly in the U.S., you'll end up owing taxman more money than you would ever make in your life on that property. That the U.S. there's a lot of regulatory hurdles, tax issues. It's much more complicated than, say, just going down to a real estate office and buying a property in London. I can go down to any agency in Shanghai and I can go buy a apartment off the plan in London. Easy, just put some money down, it's all done. So is the U.S. really going to be a compelling story with those kind of regulatory challenges?
Well, everything's a balance in life, isn't it? So, yes, there are regulatory challenges. There are issues with the process of buying in the United States. For example, the Chinese clients that we work with are absolutely skilled when it comes to understanding IRR, cap rates, and negotiating the price and terms. We're very good at that. However, when you get past that and get into the transaction, understanding the legal aspects, understanding just what happens, even what a commission is and who pays the commission and why they do, things become complicated. Then when you start to talk about, well, if we have a company, the company might have if it makes money, which we want to do, it might, and it declares a dividend, there might be a 30% withholding tax unless you plan carefully. And then you say, well, in that case, maybe we want to structure something that's like an LLC, and then the question becomes, well, what's that, and what's a partnership? And then when you go from the international tax issues and planning issues, it's a question of, oh, well, maybe there's this problem with immigration, and I bought this property, but how do I get to use it? Because unless I have a visa, I can't stay very long. And then we talk about...
You're scaring me off already.
Yes, we talk about L1 visas, and we talk about EB5 visas, and we work with all this. But we do it, and it works. But the moral of the story is that I think if you're going to be an investor in the U.S., you need to be rely upon professionals, listen to the advice that you get, and don't micromanage, and it'll work.
Right.
But also just to add to that, I'm not sure if most people know, but capital gains tax in the UK is about to triple, right up to just short of 30%. And so, you're buying, say, London right at the top of the market, yields at 2-3%. in a market that systematically is the highest it's ever been, versus, as an example, Atlanta, where you're still buying 40% below replacement cost at 8% plus yields. You know, you've got to weigh up, is it better to buy a good asset or just to worry about...
Scott, you forgot the most important element in most buying decisions. You forget that most of my friends are buying flats in London.
Correct. Which is why it's exactly not the place to buy, because we all know if you follow the sheep, you go down with them.
Anyway, before we go into the Q&A, I want to wrap up with a final question for each of you, if you can help me out with this. If you were going to give one piece of advice to Asian investors looking for opportunities in your home market, what would that be? Charles Cosgrove, maybe you could help us out with this.
I guess it would depend a little bit if they're a wealthy individual, if they're institutional.
Let's say if you're working with private equity people. So let's say I'm a private equity fund out of China or out of Hong Kong. What should they do?
Well, that's a little different. I mean, that's typically a 7-year fund.
Mm-hmm.
It's got 3 years to get the capital out. It's got another 4 to get it back. The GP, the managers, unfortunately got a bit of an incentive to get the capital out because he's time limited, so he may not be able to time it. So I would rather not phrase it in those terms.
Okay. Well,
I would rather put it in terms of, let's say, a wealthy individual, doesn't have to be Chinese.
Mm-hmm.
I would invest in universities, towns and cities.
Okay.
Moderate risk profile, somewhat diversified portfolio, probably not residential. Mm-hmm. And I think except that the leasing structures in the States are more supportive of kind of an underwritable cash flow over 5 to 10 years. You can swap rates into something fixed without too much of a cost. And I think you can kind of sleep well at night. You not swing for the fence. If you're talking about in kind of the 10, 15, $20 million range. If you go much above that, I mean, obviously, we don't have enough time to talk about that.
Okay. Philip, what about you? What would you like to suggest for these investors?
I will not help individuals but institutions, because that's 10%. The retail stuff is 10% of our business, so it's basically institutional. And then I would say yes, include the listed sectors. I won't say uniquely Europe. I think we have very good friends, contacts with our friends in the US. I think the listed space as such is important. For Europe, you get 14,500 assets with a total gross asset value of 220 billion in all major European countries, which means in major European cities. If you buy a UK company, you buy 95% of the assets are in the city of London. The same can be said for most of the others. Except, like I said earlier, for France, where you have some pan-European exposure. You get access to all sorts of sectors, whether it is from hotels to resi to retail, healthcare, you name it. But I think most of all, you get the sort of stability, like you said, you can sleep at night. You get, based on past experience, very good returns. The last 15 years was 8%. Total returns beating all other asset classes. If you look at pension fund studies that have been done by one of our universities we work with, you show that over 20 years pension funds had a return of around 7%, REITs returned around 10.5, direct 6.7, it's very cost effective, direct costs you 83 basis points, listed costs you 41, so I think that is enough of a track record. What I will do then is make a basket. I would make a basket of a number of countries, number one, or we run, like probably quite a few of you know, an index, which is the FTSE EPRA Europe index, and globally the FTSE EPRA Maybe index. I would use that index. On the European side, we have run it since 2000. There's 250 billion of assets that are in the index. There's also an ETF. So there's plenty of ways to use the sector in its optimal way.
Charles, what would you recommend?
I will let the foreign investor or the Chinese investor use their intelligence and study the best asset, whatever they think is the best. But and they'll know where the best place and where the best type of asset to buy is. But I just want to give this tip, if I could. The tip that I would give is, before you act on any property overseas, and especially in the United States. Be serious, think it through, know what you want to do, know what asset you want to go after, narrow your locations to 1 or 2 places. When you're ready to act, study the process in the United States. Before you act, know the people that are involved, make a relationship with a lender, find a trusted advisor, and then after you feel that you're ready to go, act quickly. You will not have a lot of time to dilly-dally because a seller is not going to wait for you. And you're going to irritate everybody in the transaction, the seller, the lender, the lawyer, the broker. And if you want to do business again or repeat another deal, which you should do because you can roll over into 1031 exchange, you should think, know the process, be serious, and act quickly.
Scott, what about for you? What's your advice for our wealthy Asian investor looking to go overseas?
I think the most important thing is, it came up this morning with Dr. Amlin Roy, it came up at MIPIM, it came up in the DLA Piper report. Follow the trends that make the most sense based on where population is going. And medical and aged care is certainly one of them. It's one of the most economically resilient trends. The populations in the first world are getting older. No matter what happens in the economy, they need doctors, they need aged care. And doctors don't move, so it doesn't matter whether it's $10 cheaper down the road, they stay in the same place. It tends to be the leases that stay with the building and also the licenses, so they can't just move down the road. So they're very, very economically resilient investments. The second thing is to find the right partners, and takes time, it takes years actually. Yeah. And that's why you need marketplaces, that's why you need the Alibabas of the future. And really from our perspective, that's why we are so passionate about what we do. Hopefully with time, all our esteemed partners will be, that are on this stage will be partners of ours working together. And the last thing I would say, which is probably the most important thing that I've learned in my life, is that if your interests are not aligned, you will fail. If you marry a woman and she has a different interest to what you do long term, it will not work, or vice versa. If you go into business, it is exactly the same thing. In property, make sure that your interests are aligned with the other partners that you're partnering with. If they're trying to take all the money on the front end and you want to make a return on the back end, it will not work. Get to the detail, get to the devil of the detail of the deal, and make sure that your interests are aligned.
Okay. I think we've got time for a few questions here. Any questions from the audience? Sorry, in the back there.
You mentioned about the visas in Europe, with a lot of the European countries. Is there something which you see as a potential to stop, though, with the fact that if they keep buying visas, they are, of course, exposing themselves to the government as trying to get their capital outside of China in places and trying to get themselves.
So you think you're asking really, is there sort of a stigma being involved in being a visa-driven investor?
Correct.
Anyone want to tackle that one? There is a lot of stories about the government trying to clamp down in China anyway on people taking capital out of the country, sort of nefariously gained capital.
Look, I've said it already, but I'll repeat myself. The best visa you have on the planet is to have global wealth. My uncle bought his way into Australia at the age of 53, bought a house for $1.8 million, put his kid through a private school, and as I always joke, he didn't have to work for an Australian. So, the point is, if you've got good assets with good income in the first world, you can buy your way in wherever you want to.
I think that in terms of, there are a lot of headlines about, say, Operation Fox Hunt, where the Chinese government is going after people that have absconded with funds or that have ill-gotten wealth. That's a pretty small segment of the overall immigration story, and it's a very even smaller segment of the overall real estate investment story. So we have another question up here someplace. Yes, sir.
Just a question, not comment on what you said, Charles, about the complications. The complications, this is complications of investing in the United States.
Yeah.
I don't think so. I don't know if you're going to wait for a microphone.
Well, why don't you speak loudly, and I'll try to paraphrase your question as much as possible.
There are many more complications and regulatory requirements of investing States, but the market has shown that with supply and demand, there's still a huge demand for investment. The population of the States is increasing. Germany would have had a shrinking population had it not been for its imported workers, and notwithstanding the current interest in investing in Berlin. So it's the only country, the United States is the only country on this planet that taxes people on the basis of their citizenship or green card status rather than residence, the way every other country does, and now I can hear it's on. But that doesn't hold back the masses, so there's got to be a reason why it's still appealing. And part of it is that the cost basis of things is a lot lower there. I'm always amused in my travels around the world that duty-free prices in most parts of the world are still higher than just ordinary shop prices in the States, notwithstanding the sales tax that gets added there. So it swings and roundabouts. And I would say if you've got 100 million to invest, don't invest it in one city in one country, spread it around a bit. Not $100 in 10,000 cities, but break it up a bit so that you're covered for fluctuations in exchange rates.
Yeah, I think it's an excellent point. I agree with you. The investing in the United States absolutely requires a high degree of professional skills to assist the investor. You have to have a good lawyer, you have to have a good banker, you have to have a good immigration lawyer. You have to have a good international tax attorney. Just to give one example of following up on what you say, I said before that, yeah, there's a withholding tax of 30% on a dividend going back to a Chinese investor. And the typical way somebody would structure an investment would be through a Texas or California LLC with a Delaware holding company and then going back to a Hong Kong parent. But did you know that with proper tax planning, there's a U.S.-China tax treaty that reduces the withholding tax on dividends to 10%. And there's other ways that we can use doing with some international tax planning to solve that problem. Did you know that there are ways to use the immigration laws in a proper and correct way to solve some of the immigration issues? In order to do all this, it's not going to be learning how to do it on the internet, which we find a lot of investors trying to do, to learn how to invest in the United States on the internet. The last deal I did, which was larger than an 8-figure deal, the Chinese investor was absolutely skilled in understanding IRR, but when it came to understanding what net operating income was and debt service coverage ratio, it was like, excuse me, what is that? What is that? Well, that's going to affect whether or not you're going to get a loan or not. So with proper advice, yes, it can be done. Another interesting factor is, and I don't mean to hog the stage here, but the EB-5 visa program actually started in 1992 in the United States. In 1992, I think there were like 5 EB-5 visas given to people. In 2012, I think the allocation for EB-5 visas only used 60% of all of the visas. I think it was 10,000 set aside every year. Only 60% was used in 2012. In 2013 and 2014, by the time August had come, all 10,000 were used, mostly by Chinese investors. There's a backlog right now. We're waiting for Congress to extend the program. And as I said before, the smart Chinese investors are actually doing their own regional centers and EB-5s, and they're selling like hotcakes if they're structured right.
Okay, more questions? I think we have a question way in the back.
Hello, I'm from Berlin, so I from Berlin, so I'm giving you the chance regarding the question about Berlin. First of all, I think as everybody said, a visa is not a problem, and after Paul Macker visited Beijing, and it could be solved even quicker, I believe. And second, yes, that's true. Germany, the population is decreasing, but Berlin is increasing. Every year, 30,000 new people move to Berlin, and this popped also up. Also, what they said about the art industry, and yeah, I think That makes a lot, and also GDP, Berlin is the highest among all the German cities. So, GDP increase, I mean. So, welcome to Berlin. See you.
Okay. I guess maybe the question we could get out of that is, well, it's very possible to, we're talking about countries quite a bit, it's very possible to have a country where the picture is kind of mediocre, but a city in that country where it's very positive. Is that are we seeing instances of that?
I think it's correct for Europe for sure. I see. I'm obviously I'm totally not an expert in this area, but I mean I can see from what I read as a trade press that there is definitely a tendency for governments to relax their rules with regards to immigration and the levels people need to spend.
Okay, well, we're a little bit over time here. Do we have one last question, or do we wrap it up? Anyone else? Okay, thank you very much. You've been a lovely audience. Please join me in giving a applause.